Good afternoon. Good afternoon. It's Monday, the 2nd of February. Another edition of Monday Market Picks on your way. My name is Tilan Wickramasinghe. I'm the head of research for Maybank Securities here in Singapore. Now, we have a new Fed chairman nominee after many months of speculation, Kevin Walsh. He's seen as a pragmatist and he's likely to shrink the Fed's budget, which will ease some inflation concerns and which will actually bring down the longer term interest rates in the US. And he's also Trump's man. So it's likely that he will be quite hawkish on bringing down interest rates in the short term as well. Now, all of this is actually quite good for the REITs, especially in Singapore, because that makes their dividend yields quite attractive. So today we're going to speak a lot more about that. We're going to have Krishna here to talk about the Singapore REITs. And also, Singapore itself is looking most likely to tighten monetary policy given higher inflation risks. And we have economist Brian joining us to discuss what that means for short-term and domestic rates in Singapore and also the Sing dollar. And then we also have Eric joining us to talk to us about Coliwoo, one of our recent IPOs on SGX and their latest M&A, plus ISOTeam as well. So quite a few things to go about today, but let's start with Brian and let's start with macroeconomics. Brian, welcome to the show. Now, MAS has maintained their Sing dollar appreciation slope this month, but has warned of upside risks for growth as well as for inflation. So let's start with growth. Where do you think these upside risks are coming from?
Hi, Dylan. Yeah, thanks for having me on the show. MES and MTI, they have been expecting Singapore's economic growth to slow this year as a result of, tariff-related pressures, right? They expected the payback from higher US tariffs to show up eventually, causing a slower growth in our manufacturing and also trade-related sectors. However, based on what we see, in what's happening early this year, it looks like our growth momentum is still growing very strongly. And that has nothing to do with tariffs. That's actually due to the AI capex boom, which is still going strong, with the America's top six hyperscalers estimated to still increase their capex by 36% this year, even though a slower pace than 50% last year. So as a result, when we look at leading indicators such as the electronics PMI and also export orders, these are continuing to climb. And the likelihood is for the fourth quarter of 2025 GDP growth to be upgraded to 6.5%. That's nearly 1 percentage point higher than the flash estimate. So I think overall, with this ongoing AI boom, it looks like there is upside to manufacturing growth and also growth in our trade-related services sector. So yeah, I think MES is thinking about that as well right now. Yeah.
Okay, so that's one side, that's growth. On the other side, there's inflation, and MAS is saying there are some upside risks there as well. So, what are the risks there, and how do you think MAS's policy trajectory will kind of respond to this going into April and June policy setting meetings?
Yeah, so if we recap right now, core inflation is still low. It's at 1.2%, and it's been relatively stable for the past 2-3 months. But first thing first, the upside risk to inflation comes from growth in itself. Because with the output gap estimated at about 1.5 to 1.6% of GDP in 2025, and with growth momentum still going strong, it looks like the output gap is not going to narrow much this year. And as a result, we have essentially growth running over and above the economic capacity, which could build up demand side pressures such as wages and also other inflationary pressures. There are other upside risks to inflation as well. One thing to take note would be the silicon price shock from the AI boom, with rising with memory chip prices rising steeply. That could result in hikes to consumer electronic prices this year. And I guess another driver that we are watching closely is China's export price deflation, which was one of the factors in keeping Singapore's inflation down at below 1%, even trout at like about 0.5% in last year's second half. But this year it looks like China's export deflation is going to narrow with the efforts to curb overcapacity. And finally, I think the upside risk that we're looking for, which is the most wild card also, is geopolitical shocks. With, for instance, oil prices already climbing as a result of geopolitical tensions and the prospect of a broader Middle Eastern war in Iran. And of course, aggressive global fiscal spending, which could be essentially a liquidity injection into the global economy and also raise inflation pressures. Yeah.
Okay, and what do you think that will do to Sing dollar and also to domestic interest rates?
Yeah, so first thing, policy implications. We think that MAS will tighten and steepen the appreciation bias slightly at the April or July policy meeting. Right now, the Singapore nominal effective exchange rate is appreciating at about 50 basis points per annum based on MAS's slope. However, we think that MAS will raise the appreciation slope to 100 basis points per annum. And what this means is that there could be more upside to the Sing dollar ahead. The Sing dollar has already appreciated by 1.7% against the US dollar since the start of the year. And well, with the expected appreciation to the Sing dollar, there could be, for instance, funds position with more fund inflows to position for the appreciation. And as a result, we could have even more fund inflows into the Singapore economy, and this would drive interest rates down. To recap, we are expecting that Singapore's SORA rate, the 3-month SORA, will slide to about 0.7% by end 2026 from the current 1.15%. I think other than this, other than inflows positioning for the appreciation of the Sing dollar, there are also continued drivers in the form of safe haven inflows with all the geopolitical uncertainty that's going on globally. And also our view that the Fed will likely cut the Fed funds rate by 50 basis points this year.
Got it. Thanks, Brian. So that actually creates some very good conditions for the Singapore REITs. On one hand, you got appreciating Sing dollar, and on the other hand, you got falling domestic rates, which makes the REIT yields look quite attractive versus the risk-free rate. So it's a good time to bring Krishna in and talk about the REITs. Now, Krishna, we saw quite a few REITs reporting in the last couple of weeks. So let's start there. What are some of the key trends that you're observing from these results?
So I think for the REIT results, what we are seeing is the results so far are broadly in line with expectations. And we have highlighted in our year ahead note the title was inflecting distribution. And we are seeing the DPUs are growing and they are coming ahead of estimates. And primarily they are because of the savings and the finance expenses. Year-end valuations that so far that has been reported, we are still seeing the local assets anchoring the portfolio value and some slippages in the overseas assets. But primarily, the gains in the valuation are from the operational improvement, not so much from the cap rate compression. However, NAVs, if you see, they are still coming off, and that's primarily because of the FX headwind, the topic that you alluded to about, say, a stronger Singapore dollar. Operation-wise, occupancies are stable. The rent reversions are positive, but slowing. And the notable trend, I think, for this set of results is the stabilization of RevPAR, which is revenue per available room for the hotel sector in the second half. As well as the continued stabilization of the overseas offices in Australia that we have seen from the Suntec REIT that was reported the results. So those are, I think, the salient points. There are still some of the important REITs which are yet to report, but I think that should summarize the results so far.
True. So, I mean, when you think about the subsectors in the REITs, because this is something that a lot of investors are very interested in, what has surprised or disappointed the most? And also, how are your subsector results aligning? And I know still a few big REITs are yet to report.
Yeah, so I think as I mentioned in the previous answer, that I think the key thing, which is to positive thing to noteworthy trend, was primarily the stabilization of the RevPAR for the Singapore hotels, and also I think that is well not a I will not say a disappointing one, but it's broadly in line with our expectation. Is the moderation of the positive rent reversion for the Singapore retail sector. So those are the things I think which stands out. In terms of our subsector preference, we are still maintaining our subsector preference, which is the Singapore commercial sector, followed by the industrial, and finally the hospitality sector. But I will mention that the hospitality sector is under-owned, and there is room for an upside surprise based on how the arrivals and the event calendar pans out.
Got it. And now, when we think about this lower rate environment, how are your top picks panning out? What are your top picks right now?
So potentially in the lower interest rate environment, what we have is the REITs which have not hedged their debt will benefit the most. So in that context, the hospitality sector stands out. So those will be CDL Hospitality Trust as well as Far East Hospitality Trust. Apart from that, you also have some of the highly geared commercial REITs which will benefit from the potentially lower interest rates. So these include Suntec REIT, OUEREIT, Lendlease Global Commercial REIT, as well as Keppel REIT. So those are the beneficiaries in a potentially lower interest rate environment.
Okay. And then, we've also upgraded CDL Hospitality Trust to a buy. Can you give us a quick pitch on
Yeah.
what's driving this?
Yeah, so this morning, my colleague Meow Meow, she upgraded the CDL Hospitality Trust to buy, and that's primarily because what she thinks there will be a substantial improvement in the DPU of about 12% for FY26, and this is led by the completion of the various asset enhancements that they have undertaken, plus the RevPAR growth in Singapore. As well as the stabilization of the UK living sector, where CDLHT has made substantial capital allocation. And finally, the savings in the finance expense as well. So all these will contribute to the DPU growth, and hence she has upgraded the name to a buy.
Got it. Thanks, Krishna, for that.
Thank you,
Let's
Tilan.
move on to ISOTeam. Now, this actually is a small and mid-cap stock, which can actually benefit from all these EQDP funds that are coming through. As you remember, a lot of these fund mandates have a small and mid-cap focus. So we think that this is a stock that can benefit from that. It's also one of our high conviction opportunity plus stocks as well. Jarek sees strong near-term momentum building with ISOTeam securing about $27 million in new contracts, lifting their order book to close to $180 million, which gives us very good revenue visibility for at least the next 18 months. We are also encouraged by the faster pace of government tenders, and based on historical run rates, we expect another 20 to 30 million of orders by March this year, reinforcing our pretty strong growth outlook for 2026. We also believe the upcoming drone deployment is a major inflection point as ISOTeam's AI-powered drones painting solutions come online, and it has the potential to cut costs by 30 to 40%, and they begin live testing around the second quarter of this year. And we also think that they've got with this, ISOTeam gets a pretty clear competitive moat because they're the only contractor so far in Singapore which has drone capability. And that aligns perfectly with what the government is trying to do in terms of trying to reduce manpower and also increase labor productivity. We expect earnings in 26 to come up quite materially. Several delayed projects will be recognized in the first half, while the recent acceleration of contract wins should feed directly into profit growth as well. We also see potential upside from capital management with the possible 7 to 10 million Sing dollars of non-core assets being sold, and that can actually be part of special returns to shareholders as well through special dividends. So we are maintaining a buy call on this stock with a 10-cent target price. So do look at Jarik's note for a lot more detail in today's newsletter. Now, with that, let's bring Eric on the show to talk about Coliwoo, which has been a recent IPO. Eric, Coliwoo has done their first major acquisition since their IPO. Can you catch us up on the deal?
Hi, Tilan. Thanks for having me. Yeah, Coliwoo has just entered into an option agreement with a wholly owned subtrust of ESR REIT to purchase a hotel strata lot at 2 Chinese Business Park Avenue 1 for 101 million. So this property comprises a hotel block with more than 250 rooms and a retail space at the ground floor. And the deal is structured as a leasehold estate with a tenure commencing from the completion of the deal. We also understand that the agreement includes an option to renew for a further 30 years. So this will help to secure Coliwoo long-term presence in this strategic area. The management aims to complete the transaction by the end of March 2026.
Okay. And when you listen to management, what do you think is their sort of M&A or acquisition trajectory going forward?
Yeah, so post its IPO in November last year, Coliwoo has been actively expanding its portfolio with assets that demonstrate clear repositioning potential that is able to transform mature hotel or commercial properties into higher yielding and specialized co-living assets to achieve their full economic potentials. But besides acquisition, the group is also looking at to pursue a more asset-light strategy through master leases and management contracts, which will increase their room capacity. We understand that the management targets to expand its portfolio from current 2,009 rooms to almost 4,000 rooms in Singapore by the end of this year.
I see. And so why should investors buy this stock?
Okay, Coliwoo is currently one of the largest co-living players in Singapore with about 20% market share. We think that Singapore's safe haven's status as a regional business, medical, and education hub makes co-living a preferred option for many young professionals and students, especially given its flexible lease terms and unique community living experiences. In addition, the group has a strong pipeline of new launches. They will add at least 800 rooms on a yearly basis to its portfolio. So, very clearly, this will drive very strong earnings growth over the next 2 to 3 years. And we have a buy rating, target price at 74 cents. Dividend yield is also quite decent at about 4%.
Got it. So again, another yield play as well, plus growth, and gearing into the structural drivers in Singapore, where a lot of young people, as they come into Singapore, would look at this as an alternative to renting a unit on their own. So do look at Eric's note as well. Also now, as we approach the Chinese New Year, Maybank's Feng Shui Guide to Prosperity is out. If you haven't managed to get one of these nicely printed hard copies, that was available during our live session last Saturday at SGX. You can download this from our newsletter today. It has all the information you need for the auspicious sectors for the year of the fire horse, as well as your own zodiac predictions as well. So do have a look at that as well. And then finally, we got quite a few events coming up, a lot of results. ESR REIT out on the 4th of Feb. SGX results, I think a lot of people will be watching out for that. That's out on the 5th of Feb. I will have some comments on that as soon as the results come out. And then the banks start reporting with DBS out on the 9th. Plus some of the big REIT CICTs out on the 6th, and then developers like a CLI out on the 11th of Feb, and we top off next week with iFast, which will be out on the 12th of Feb. So quite a few things happening, quite a busy month. So do remember to dial in and join us on Monday Market Picks. Unfortunately, that's all the time we have today. So thank you very much for joining us. Have a profitable trading week, and we'll see you next week.